Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by our company, LifeChamp. Today, our webinar title is Dividend versus Growth Investing, which is more suitable for you. So this is the title for today. And my name is Shane Chu. I'm the moderator for this webinar. And before we begin, as usual, disclaimer, whatever we share in this webinar is only for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment decisions, you're 100% responsible for all your investment risk. Now, allow me to briefly introduce our speaker today. He is the content producer on kclao.com and has written more than 300 articles. He is a regular webinar host and presenter at kcla.com, and he's also the co-founder of Dividend Vault, where he transforms newbies into investors who can build dividend portfolios independently via education. He himself is a dividend investor, and he yields around 2 to 10% per year. And today, not only will he discuss about dividend investing, he will also share with us the characteristic of growth investing so you can do a comparison whether you're more suitable to do growth investing strategy or you're more suitable to do dividend investing strategy and what does each one of them entail. So without further ado, let me hand over the session to our speaker today, who is none other than Mr. Ian Tai. Ian, how are you today?
Hello, Shane. Hello, everybody. Good evening to all of you. I'm doing good here. And
All right,
hopefully
cool.
you too, Shane. How are you
Yes,
doing?
I'm doing fine. So let me stop sharing my screen and hand over the control to you.
Sure. Thank you so much. And once again, thank you so much for having me onto your platform and to actually present to your audience and as well as the audience of Bursa Malaysia. So thank you so much for this wonderful opportunity to share. And for this session, I prepared a lot of materials. So let's get into it, yeah? Let me just share with you my screen. Okay. All right. So before I begin my session, so let's just make this a very light-hearted, easy session. Today's session is not going to be super technical. It's rather going to be more like a personal sharing from my point of view lah. All right. So guys, if you like to actually interact with me, just feel free to just put in your comments at the chat box. And of course, if you have any questions along the way, feel free to post them. No need to wait until the end of my sharing session. You can just post it whenever I am presenting. All right. I'll be happy to actually address all of your questions right after this sharing session. Okay, so let's assume today, just want to get to know you a little bit better. How many of you are actually in your 20s? Maybe you can actually type in 20s, all right? And if you happen to be in your 30s, type in 30s. If you happen to be in your 40s, type in 40s. If you happen to be a retiree, 50 and above, just type in so Mahdi Abdullah says, Sudah tua. Okay. Ahmad Hamza, 30s. Afika, 30s. Lin Yap, 40s. Oh, 50s. K.Ao Chan, 30s. Eugene Wong, 29. Oh, birthday haven't come. Denial. Zachariah, 60. Oh, so there are quite a number of you guys who are in between 30s, 30 to 50 years old. Okay, but then the thing is that there are some of you who are in your 20s today. Okay, so we have a mixed crowd today. And the most senior of all attendees will be Ahmad Johari. Thank you so much, sir, for attending this webinar session. You are now, because what I see here is 80. So it's like you must be the most senior lah. Okay. I haven't seen anybody who actually get past through 90s. So you are the most senior. Thank you so much for attending. All right, back to this slide. So regardless of your age, let us bring back to a time where you are in your mid-20s. You are starting off with a career. You're building a career. Very new to investing. And let's say right now your investment capital is 30,000. So let's do a case study. So assuming that you're in your mid-20s, building a career, very new to investing, and you have saved up 30,000. So the question is this: what is the most effective way to grow your 30,000 or whatever little capital that you save to, let's say, hitting $100,000 in stock portfolio? Okay, so which route is actually better? Or which of the two strategies do you think is actually better? Is it A, dividend investing, or is it B, growth investing? Type in the chat box, which of the two do you think will actually lead you to the promised land, which is the $100,000 in stock portfolio? Okay, so we have Syrian growth. Okay, Ahmad Amza B, CS Wang B, Tan En Chi B. All right, Lee Yongqiao B. Chu says A. Okay, so you are the first one who says dividend investing. Afika Samsuri A. Okay, Gan Kok Cheng B. All right. So Eugene Wong. Okay, much lengthier answer. Good to know. Later I'll read your comments. All right, thank you so much for your comments. So I would say that there are lesser people who actually answered A, and there are more people who will go with B. All right, thank you so much for your response. So let us actually have an intellectual discussion about which of the two paths is actually much more suitable for you, lah, okay? Because at the end of the day, what matters is actually your own personal journey, not other people's journey. It's your personal journey, okay? So I'm not going to comment whether which one is actually better because different people memang have different styles. So let's actually examine which of the two is better. Okay. So now, here are I would say the issues that people have when it comes to the two paths. So let's start off with dividend investing. So typically in Malaysia, in Bursa Malaysia, if you can actually if you are actually going on this route, which is dividend investing, you can actually find stocks that are paying around 4%, 5%, or 6% lah in dividend yields. Somehow you can find it one lah, okay? If you look long and hard enough, you will have a stock list, or you have a watch list of about 20 to 30 stocks where they are paying about between 4 to 6% lah. I think that one is actually quite achievable. But let's just say the average dividend yield is about 5%. So the issue that people have when it comes to 5% dividend yield is it is actually too slow and it is not very exciting. So which means to say, for instance, let's say you save up $30,000 in capital, and based on 5% dividends, you will be expecting to get, if let's say 5% dividends, you will get a dividend income of 1,500 per annum. So if you work it out, it will be on average 125 ringgit per month. So this is your average dividend income on a monthly basis. So how many of you here say, so now there are two questions. How many of you think that this is actually quite possible? That's the first question. If you think that this is actually quite possible, type in possible. And how many of you think that this is also a bit too slow? Type in also. So if you agree with these two, you can say possible, too slow. Okay. If you think that this is not possible, just say not possible and leave your comments. Let's see what you guys are saying. Okay, so most of you guys says possible, tapi terlalu perlahan. All right, possible, very slow. Possible, very slow. Okay, I get you. So which means to say you guys are actually believing that hey, this is actually quite achievable. However, it's a little bit slow. Okay, so this is the common issue with dividend investing. What about growth investing? Okay, so now let's shift our focus to growth investing. So how many of you think that this is actually the faster way to actually get to your $100,000 portfolio? So which means to say for growth investing, we just aim for capital appreciation. So if you think about it, imagine you have $30,000 saved up and your 30,000 can actually appreciate by 50%. So 30,000, 50% appreciation, boom, your portfolio will grow to $45,000. And if you happen to double your money, it is $60,000. And if you can somehow triple your money from 30,000, if you triple your money, you will get 90,000, and you are just $10,000 away from hitting the six-figure mark, which is $100,000. How many of you believe that this is actually the faster route? And it's not just faster, it can also be a little bit more exciting. How many of you agree? Just type in the chat box saying agree. All right. Yeah. Okay, so I can see agree, agree, agree. So Chiu says good but risky. Sutaralingam says faster and risky. Okay. Eugene Wong, too risky. Okay, okay. So a lot of people may want to aim for this because this seems to be faster. But then some people actually say, hey, wow, if I can double my money, if I can triple my money, but then the pullback is, oh, it can be a little bit risky. All right. So now we have two problems. So now we can see the problems here. Dividend investing, possible, but it's too slow. Growth investing, wow, double your money very fast. Okay, you think that it's a fast track towards your 100,000, but oh, you pull back because it can be a bit risky. So mark that lah. So just put that in your mental note for the time being, and let's move on. Now here I would like to share with you, okay, why is it that most people, when they start off stock investing, right, they kind of like fail to actually hit $100,000, at least $100,000 in their stock portfolio. So what is actually the number one reason of why people fail? So this is what I've gathered. Let's see whether you agree or not. Okay, supposedly you have some capital saved up, let's say 30,000. So the next question is, let's say we want to actually go into growth investing. So now the question is this: what stocks would you want to buy? What are the growth stocks that you may want to actually buy? So how do you source for information? Number one, type in the chat box. How many of you here, when it comes to finding stocks, you will definitely read, you will download, dig out, and read annual reports? Type in yes if you are the type that will read annual reports. Type in no if you are the type that you won't read annual reports. Okay, so we have Alex says yes. Zachariah no. Chiu says yes. All right. Mujahid says yes. All right, so we have yes, no, yes, no. Okay, so we have more yes than no. Very good. Okay, very good. Thank you so much for your response. So the thing is that for most people, I mean to say for those people who actually fail, the reason why they fail is actually simply because when it comes to finding growth stock, the best way to actually find growth stock, right, is not through news media or whatsoever. It's actually through reading annual reports. And all these annual reports are actually, they can be sourced, they can be downloaded from Bursa Malaysia website. It's all there for free. All right. So it's just a matter of effort and time to read annual reports. However, two problems may arise. The first one is that people may not know how to read annual reports. That's the first one, which means say you give them a stack of financial statements, they may not know how to interpret it. Type in the chat box if you know how to read annual reports and you know how to read financial statements. Type in FF. Type in financial statements. All right, type in. Let me just see whether. Let's just see how many of you know how to read financial statements. Okay, so a lot of you know how to read financial statements. Very good. How many of you say? So there are two problems. The first one is that don't know how, but apparently over here, some of you know how to read. Okay, maybe there's one. Afrika do not know how to read. Thank you so much for your honesty. Then the next one is that how many of you here don't have time to read annual reports? Just also say don't have time. Okay, so which of the two problems you have? You just type in the tab. You just type in the chat box. If you know, just type in know how to read, don't have time. If you say, don't know how to read, don't have the time, also write both. No, don't know how, no time. But if you have a habit of reading annual reports and you have the time, just type in, I do both. Let's see how many of you do both, okay? So, all right, so some of you say no time. Bong says no time. Lucky got Mumu app, okay. Xiu Feng says no time, too cumbersome. All right, thank you, thank you. So Jaslyn comes says past performance does not guarantee future result. Afika says don't know and no time. Mujahid says I do both. Night for research. Fantastic. All right. Chiu says I do both. Very good. Okay. Thank you so much for your response. So typically the people who fail will have these two problems. Either they do not know how to read annual reports or financial statements, or they just don't have the time. Okay. So what happened is that they will actually seek for alternative information. Information like social media. So these days there are many, I would say presenters lah, or influencers who will actually appear on YouTube, Facebook, TikTok, or if you happen to read Chinese, that is 小红书 for you to actually go through their social media platforms, and you can actually find some materials over there. So these are alternative form of content lah. Annual reports is the primary one, but all these things are secondary and tertiary source of information. Or you will read newspapers, or you will use an app, maybe from a broker like Mumu, all right? Maybe from a stockbroker, you read brokers' reports. Maybe from there, you actually get your source of information. Or the worst of all, you rely on friends or family, which means to say an uncle, an auntie, father, mother, friends, cousins, colleagues, or your social circle of people lah. All right, whatever they tell you to buy, you buy. So this is actually some of the alternative sources of information that you could be getting that might influence you to actually buy a single stock. All right. Yes, I agree with you. Alex Lee, friends and family, the worst. True enough. Yeah. So that is actually the case. All right. Tell me, guys, look at the screen. So I have presented to you three truly from Bursa Malaysia. These are three actual Bursa stocks. All these things are from Google Finance. How many of you believe that these are all growth stocks, and you are actually interested to find this kind of stocks? Put in yes or put in G. All right. If you happen to wanting to find this kind of stocks, or you get excited when you see a stock where the stock price looks something like this. All right. So Tavaligam says G, Mazlan G. Yes, a lot of G. Fantastic. Okay, thank you so much. So we have quite a number of stocks that will actually that will have a stock price behavior, something like that. And a lot of people think that because they don't read annual reports, so their best place, right? Their best bet when it comes to finding a growth stock is to look at stock price chart. And whenever they look at stock price chart and they see that stock price is growing like that, growing by 3 times, 12 times like this, they will think that this is actually a growth stock. All right. So for most cases, the very people that fail believe that these are growth stocks, and therefore they will buy into these stocks. So the question is, where do they buy them? Do they buy them here? Hopefully lah. But most of the time they might buy somewhere here or somewhere here, either in the midst of it, and then it's still continue, and then they continue to grow. Then it's a bit like, oh, very lucky lah, very fortunate that they buy into that stock. So therefore they write on the growth. Okay, it's the same over here, it's the same over here. But the worst case is that what if you happen to buy over here, and over here at the peak, right? So when you buy at the peak here, most of the time people hope that these growth stocks will continue to grow in terms of its stock prices. Now, here is the thing. If you get excited with this kind of stocks that have been growing very rapidly over the short term, how many of you, these are the same three stocks, how many of you will still be motivated to invest after experiencing this kind of events? These are the same three stocks. As you can see, the stock price has been growing, all right? But then after they have grown very rapidly, over time, they just stagnant, they just plateau, or they slowly, gradually, and progressively, they kind of like decline and wither down their growth. So like here, drop by, over a span of 3 years, drop by 27%. How about this stock? This stock has actually fallen by 67% over a period of 3 years. Over a 3 years period here, dropped by 46%. How many of you will become demotivated after looking at this kind of stock price? All right, type in demotivated. Let's see your response. All right, Mujahid says demotivated. Okay, so a lot of you guys actually says demotivated. So which means to say, sini, if we see saham, harga saham, stock price, naik harga, you become motivated. Wow, this is growth stock. Motivated. Motivated means you might actually have the adrenaline to buy these stocks because growth stock. All right. But then after you buy them, after 2-3 years later, tak ada grow. The stock price didn't grow. And because the stock price somehow didn't grow, you just hang around there. Your stock is like doing nothing. So therefore become demotivated. Okay. So in this case, this is actually what most people do. Number one, they become discouraged or they become disappointed. They say, I thought I'm actually investing for growth. But then the thing is that it didn't grow. So they become disappointed or they become discouraged. And what happens when people become discouraged? People just forget about investing. Just forget it. This thing doesn't work. And when this thing doesn't work, they just forget it. They just forget about it. They will choose to sweep under the carpet. And what they do is that they just somehow lupakan je lah. All right. Just buat tak tahu lah. Say, oh, I tried growth investing, but then somehow it didn't work for me lah. I think I should be doing other things lah than investing. So what happens is that they give up and forget about hitting the 100K. All right. Now type in the chat box. Just now, these are the problems that I have described. How many of you kind of like know someone who is something like that? Who is somebody like that? Type in, say, yeah, I do know. Okay. So yeah, if you happen to know anyone, not just I mean to say, if that person happen to be yourself, you can just say yes lah. Don't need to disclose lah. But if you happen to have a brother, a sister, a parent, a friend, a colleague who is something like that, just type in yes. I think I know someone who is something like that. Just type in. So a lot of you guys say that, yeah. So Eugene Wong says, yeah, especially during the glove craze. Exactly. Yeah. This is actually one of the classic examples. Yes. So a lot of you guys are following the story. So just now I have spent about nearly 20 to 30 minutes of time just to explain to you, this is exactly how most people fail. They start off very passionately, but then after that, they kind of like wither off. They kind of like wither off and just lupakan. So when they lupakan, it is 2 years, 3 years, 4 years, 5 years, or even 10 years. Some who are very hurt, some who are very disappointed may not actually want to invest for the next 10 years because they are just disappointed. So it could happen. And this is exactly how it happened lah. Okay, why people fail. Okay, so when you know this story, which also means that if you happen to be listening to this webinar session, avoid doing what I have just narrated. Okay. Now, the thing is that whatever I have just narrated, right? what people don't realize is that they are not exactly investing. Okay, they fail not because they are really investing. What they don't realize is that these people that I just mentioned just now, they fail because what they are actually doing is speculating, thinking that they are investing for growth. So which means to say they are not doing growth investing. What exactly they are doing? Speculating. Okay, there's a difference, world of difference between investing and speculating. So just now, whatever I've just mentioned, how they failed is because they speculated. So that's why they failed. But if they have been investing, maybe their chances of investing, the chances of them getting results, positive results, will be much higher. Okay, so here I'm going to just share with you the following. Welcome to the actual webinar session. So these are the webinar outlines for today. So just now it's just a teaser as to how people fail. Now we are going to go into what makes a person, whether or not you choose dividend investing or growth investing, how you can be successful. Whichever route you choose, you still can be successful. So the first thing that I would like to do is to provide a simple definition of value investing. And then we will go through one similarity between both dividend and growth investing. After one similarity, I will proceed to explaining one big difference between the two styles of investing. And then I will share with you my personal journey to hitting my first 100,000 in stock portfolio. Then from there, you can actually decide how you want to craft your own portfolio so that you can get to your $100,000 mark. And of course, some of you guys are already 30, 40, 50, 60 years old. You already might have $100,000 in your portfolio. Then just treat this session as a way to get to your next $100,000. Okay, so let's get into it. Part 1, definition of value investing. So this is the general principle of value investing. So value investing is about accumulation. So it's not trading, it's accumulation. Means it's not about buying low to sell high. It's not the case. Accumulation simply means I buy, I simpan, finish. I buy to keep and hold. So it's accumulation of shares of fundamentally good businesses. So we are looking at businesses, okay? Businesses that deliver consistent growth in sales and profits and operating cash flow, not trading mindset, business minded, okay? So when do we accumulate them? When they are undervalued for the long term, okay? So these are the 4 keywords. Accumulation means buy to keep, never to trade. We look at fundamentals simply because we are looking at businesses that deliver consistent growth in profits and cash flow. Undervalued here doesn't mean we look at stock price. We look beyond the stock price, which is we look at some valuation metrics like PE ratio and dividend yields. Last but not least, our holding period is long term. Long term is not a few months or a few years. We are looking at way longer than that. It can be treated as our retirement portfolio. Okay. So as long as the businesses continue to deliver growth in profits and cash flow, I don't see a reason why we should sell them, unless the valuation is crazily overvalued. Okay. So as value investors, we want to find good businesses. So how do we find good businesses? There is only one way to find good businesses, one effective way. Okay, I don't have so many effective ways. I only have one, which is to read annual reports. So just now, for those of you who say I do not know how or do not have the time, right? Somehow lah. Okay, you need to actually learn how. You need to actually find the time, because there's no shortcuts to this. Of course, there are a lot of people who try to find shortcuts lah. Find shortcuts to get around these 2 problems, but there's really no shortcut lah. if you try to actually find a shortcut, most people actually they don't sustain lah. They are not there they will not be in the game of stock investing for the long run lah. So people who are staying, people like myself, for example, we stay, we sustain, we're still there investing. The reason why, one of the reason why is simply because of our ability to read annual reports. So what do we find in the annual report? There are two things lah that I will personally find in the annual report. Number one, I will be finding stocks. I'll be finding businesses that deliver consistent growth in profits and cash flow. And number two, I want to make sure, because we're investing in times of uncertainty, so therefore, my defense is that I want to find stocks that have strong balance sheet. Strong balance sheet means a lot of cash, very little debt. That's strong balance sheet. Okay. So this is value investing. Next, after we have known value investing, now we'll go into part two, whereby I will explain one similarity of dividend and growth investing. So this is value investing, where it is about accumulation of good businesses. So we are looking at fundamentals when they are undervalued for the long term. It's the same principle. So this is like the father, and he has two brothers. Okay, ini bapa dia, ini dua anak dia. So the anak dia, first one is dividend investing, the second one is growth investing. So which means to say, whether it is dividend investing or growth investing, it is within the same family. Keluarga yang sama, all right? It's the same family, same bapa, all right? And the father is value investing. It's the same thing, okay? So why is it the same thing? Let's see. Guys, all right? Before I move on, how many of you have read this book over here? The 100 Bagger book. Type in the chat box if you have read it. Say, read it. If you haven't read this book, type in haven't read it yet. Okay. So Alex Lee says no. How about the rest? How many of you? All right. No. Okay. There's anyone says yes there? Anyone says yes? Not yet. Eugene Wong says haven't. We'll read it. Thank you so much. Okay. So haven't read it. Okay, good. So I'll introduce this book to you. It's written by Christopher Meyer. You can get this in popular bookstores. MPH or Kinokuniya, you will find them. And this is actually a very good book. And this book is actually a study lah. It's actually written by Christopher Meyer after he has studied stocks that have actually achieved 100 baggers, which means to say, every $1 you invest in a company, after you have invested it, and over the long term, it will hit 100. Every dollar you invest, it becomes $100. That's why it's called 100 baggers. So one bagger means $1 become $2. So that is one bagger. $1 become $10. That's like 10 bagger. $1 become $100. That's 100 bagger. So this is a good study on all the 100 baggers, and he will list down all the characteristics. But here I will just share with you one small little concept that I have gathered from this book. All right. And over here, I have learned about this very interesting concept, which is called the role of a CEO. Okay. So now, because we are value investors, we are very business-minded, so we put ourselves, as an investor, we put ourselves macam satu CEO, sebuah syarikat. We put ourselves as if we are running the company like a CEO. So let's assume that I'm a CEO of a publicly listed company. So in the book, it says that the CEO has two jobs. Number one, to raise capital. Number two, to allocate capital. Okay, two jobs, huh? First one, raise capital. Masukkan, ambil duit, okay? Menjana duit, menjana dana, okay? The second one, how you allocate the capital, how you spend the money, right? Money in, money out. Now, when it comes to raising capital, there are three main ways of raising capital. The first one, operating cash flow, raising capital from customer, pelanggan. Number two, raising money from debt, hutang. Number three, raising money from issuing equities, saham. Okay, so there are three main ways how you can raise capital: from your customer, from the bank through borrowings, from investors through equities. Now, when it comes to investing, for value investors, whether you are a dividend investor or growth investor, the key thing here is this. The common ground between the two is that we like stocks that are very good in generating operating cash flow, very good in generating cash flow, all right, receiving cash from customers. Why? Because this is actually an indication that the business is cash flow generative, okay? And both dividend and growth investors like that. And of course, it's very logical, simply because if you're a dividend guy, you need the cash flow to pay dividends. If you're a growth guy, you need the operating cash flow to fund your growth initiative. So the common ground between the two investors is this. The stocks that you pick must be positive, must be growing in terms of operating cash flows over the long term. This is the common ground. Okay? So here I have two examples, two stocks, one dividend, one growth. So if you look at the operating cash flow, it has to be positive. And if you look at growth stock, the operating cash flow also positive. So whatever you choose, dividend investing or growth stock, or dividend investing or growth investing, when it comes to operating cash flow, it must be positive. You are buying a cash cow. Okay, that's the common ground. Now, after we know the common ground, it's time for us to explore the difference. So back to this role of the CEO. So as the CEO, I would like it best if my businesses generate positive and growing operating cash flow. Now, here is where it differs. Okay. For dividend investors, they will prefer most of this operating cash flow to be paid to them in the form of dividends. So whatever money we receive from customers, pay out to investors, shareholders in the form of dividends, most of it. Okay, so that is for dividend investors. So if you look at this example here at dividend stocks, we can see that this is actually the operating cash flow. So over here, operating cash flow. So this is the amount spent on capital expenditure, which is memang for growth initiatives. And this is the amount of dividend payments to the shareholders. So if you look at the numbers, what I can see is that most of the money here, most of the money raised over here is used to pay out dividends. So you can see the dividend payments, all these are huge numbers. And when it comes to capital expenditure, the numbers here, fewer or lesser. So in terms of proportion, I've calculated that for this particular stock, whatever money they raise here, 20% goes into capex, 80% goes into dividend payment. So if I see a financial statement, a cash flow statement that looks something like that, that is a dividend stock. And typically, dividend investors will like this kind of stock. Okay. Now, moving on to growth investor. Growth investors like to actually receive operating cash flows over here, but instead of getting dividends, they like capital expenditure, means to say you buy more property, buy more plant, buy more equipment, set up more manufacturing plants, set up more retail outlets, all this kind of stuff, all right, in order to grow the business further, okay? In order to expand the business lah, let's put it that way. That's where capital expenditure is. Or they take the money here, they go on a acquisition spree. They go and buy up other businesses. The businesses can be related, like for example, if I'm a retailer, I go and buy out my distributor or supplier. Or if I'm in the supplying business or the distributing business, I'll buy the retailer or something like that. Or I'll buy the manufacturer. I'll buy the entire supply chain so that I actually power. How do you say power? I will actually control. I will actually control the entire industry lah. I will actually emerge bigger, not just one singular player, but I emerge as a conglomerate in that industry. So that is actually business acquisition. Okay. So for growth investors, they will just prefer more proportion of their operating cash flows to be used here. Capital expenditure and business acquisition. So let's look at the right side of the screen here, where I have an example of a Bursa listed growth stock. So we can see that operating cash flow is over here. It is positive. But now take a look at the amount of money they spend on capital expenditure versus dividend payments. So for capital expenditure, you can see that the number here is larger. Okay, the number here is huge. Whereas for dividend payments, it's not to say that growth stock did not pay dividends, but it's just, in terms of proportion, it's just lesser only. Okay, so comparatively speaking, it raises a lot of operating cash flow. It spends most of it, 80% of it, in capex. 20% of it, they just reward their shareholders with dividends. So if I look at the cash flow statement like this is a classic example of a growth stock. So how do we differentiate between dividend stock and growth stock? Is based on the cash flow statement, where it allocates its capital, where it chooses to use its cash. Okay, so the one that prefers cash to be paid to them in the form of dividends, dividend stock. If they prefer the company to use the cash on capital expenditure or business acquisition, growth stock. So that's how we differentiate between the two. Okay. Now, here is actually what will happen to both of these companies, all right, in terms of valuation. Now, let's just assume that both stocks, dividend and growth, their PE ratio, they just maintain at 20. Let's assume, it's just theory, okay? Now, here's what happened. Assuming that both stock, dividend stock and growth stock, their PE ratios are 20. For dividend stock, it continues to be profitable, but because it spent lesser in terms of capital expenditure, therefore the earnings growth is slower. So when it comes to stock price growth, it is obviously going to be slower. Okay. But of course, the good side of it is that you might get more dividends. Maybe your dividend yields will be much higher. Okay. So you get higher in terms of dividend yield, but when it comes to stock price growth, a bit slower. As for growth stock, if you look here, the earnings per share grow a lot, simply because you keep on allocating capital to expand your business. So it's about expansion, growing, and keep on actually increasing the business assets, your customer base, and all this kind of stuff. So therefore, the earnings per share actually grow. So because of this, your stock price, all right, the stock price based on the fixed valuation will grow much faster. Okay, so you will still get some dividends, but lower dividend yields. But in exchange, you will get higher stock price growth. Okay, so this is actually the difference between the two, dividend and growth investing. Okay, So guys, this is actually my personal journey. You can just take you can actually take this as a guide, as a reference point. Um, not the absolute truth. I'm just sharing my own path on how I actually hit my full investor. So which means I'm starting from zero to my first 100,000. So for me, between the two, I started off as a dividend investor. So the reason why I started off as a dividend investor is simply because I believe that dividend investing is simple, easy to understand. Because what I knew back then was if I invest in a stock, the stock is a business. The business must be profitable. It must generate cash flow. And I like the cash flow to be paid to me in the form of dividends. Very simple. It's just that logical thinking. So that was what I have back then. Even now, I still practice dividend investing, but still the principle, the logic, the rationale is still like that. It is straightforward, all right? Because there's nothing fancy, nothing too exciting about it. It's just that train of thought, right? Business, profitable, generate cash flow, pay out cash flow to me in the form of dividends. Very straightforward. And once I get the dividends, I can choose to actually pay some of my bills with that dividend income, which is very nice. And the thing is that, and the good thing about dividends is this, I collect them, different stocks, different timing, but most of them, their financial reports will end March, June, September, December. So when they end March, June, September, December, they'll take about 1 or 2 months to do the accounts, calculate how much profits they will make. And then after that, they will declare their dividends and then I will get paid. So either I'll get paid on a quarterly basis or I will get paid on a semi-annual basis. So on and off, I will keep on getting cash or keep on getting dividend income. All right. And this small little dividend income at that time, it builds up my confidence. All right. I know it's very small, but let's just treat it as a small win that allows me to generate confidence. All right. So I'm building more and more confidence because of all these small little dividends that come into my bank account or stock trading account. Okay. So that is actually my reason why I started off with dividend investing. So this is actually my own journey. So I started off, let's say with 1 or 2K. So let's say 1K lah. So I start off maybe with one stock, 1 or 2 stocks, 1K, 5%. So your yearly dividend income is 500, not 500, 50 ringgit. So the question is 50 ringgit. A lot of people just now say it's too little, too small, too slow. But for me, at that time, I'm still in my early 20s. I say, never mind lah, because I know that I'm building a portfolio over time. So 50 ringgit lah. All right. And if you break it down into a quarterly basis, every quarter you get around $10 or so lah. Okay. $10, $12. At that time, you still can buy yourself maybe a meal lah. Maybe a cup of, I think at that time what I did was I spent it on chendol lah. Then I just celebrate my win lah with a chendol lah. That's what I did. That was what I did back then lah. Okay. So after that, what happened is that I just keep on working and keep on saving. And then eventually from 1K, right, I continue to build on my portfolio and eventually it hits 10K. So 10K at 5%, you still get 500 ringgit a year. Not too much, but it's a lot more than 50 ringgit. But hey, all these small little dividends, they are like small wins lah. They just keep on coming and I just keep on receiving it. So therefore, I was motivated to continue on lah, this journey of investing. Sooner or later, it become 30K. At this stage, right, yes, the dividend income is still low, but over here, I've actually gathered some experience lah. So what happened is that I have actually gone through the market ups and downs, make some mistakes here, have some small capital gains, have capital gains and have capital losses here. All right. But regardless of these capital gains and losses, dividends still flow into my bank account. So I was still motivated. But at the same time, I get to actually learn why some of these dividend stocks are getting capital gains and why some of my other stocks are not getting capital gains. Then from there, I adapt and go back to the drawing board, relearn. I learned a lot of things from this experience, like value traps, missed opportunities, and all this kind of market emotions and all this kind of stuff. Then from there, I move on. Then eventually 50K. Once you hit this level, right, 30K and 50K, from here to here, it's not too far away already. Okay. From here to here, it's not too far. By the time I hit here, to go to anything above 100K, right, it's just a process of adding on already. Okay. So this is actually how I slowly progress from here to here. How long does it take? It takes years lah. Sorry to say, from here to here, it doesn't take 1 month or 2 months lah. It will take multiple years to actually get to this stage lah. Especially for myself lah. I mean to say, coming from 20+ year old, now I'm in my 30s. So this is actually how long it took lah. All right, how long it took for me to actually go from here to here. But the key thing is this: I would not have actually continued on without all this dividend income lah. Because all this dividend income, they kept me, all these small little wins, it builds up confidence. It is actually all the positive reinforcement that allow me to stay on in the game for the long term. And that is actually how I slowly built my portfolio all the way to 100K and beyond. Okay, I just kept on going with it. So like I said, every dividend income received, no matter how big or small, now of course it's a lot bigger because the portfolio has been built. It builds up confidence. So there are capital losses that I have also experienced, but because of the dividend income, I just keep on investing until I hit 6 figures. So this is actually my own journey. You guys will have your own journey, but what is actually important here is not to actually focus on how much returns you're getting from stock investing, but rather what I think is actually more practical, right? Especially if you're new today, is to find a system, is to find a way that allows you to keep yourself, all right? To keep yourself in this game of investing for the long term. Okay, because the thing is that if you look at there are a lot of people, they actually come into the stock market, they wanted to make a lot of money, they want to actually like make or build their portfolios very quickly, but then it doesn't, but whenever they experience something which is a little bit more negative, a failure, for example, then they kind of like quit and say that this is actually not working for them. So at the end of the day, instead of making money long term, they actually stay out of the game for the long term. So, which means to say they will lose this avenue of stock investing to build wealth for the long term. So that's what happened to most people. Very sayang lah, all right? So try to avoid that. If you're new today, don't try to make the 2x, 3x or something like that. If you fail to do that, you'll get a bit disappointed. But rather, if you just aim small, modest gains, never mind one. As long as you keep on winning, you will continue to build from there. And that's how you actually slowly progress your way towards the 6-figure mark. And finally, over here, I would like to share with you how you can actually build a watch list in regards of your choice, be it dividend or growth stocks. Okay. Then after that, I would like to answer any of your questions, all right, that you post. And I'm very happy for all your questions, by the way. So let's see. So in the context, I'm going to just limit it to Bursa Malaysia, most of the fundamentally good stocks, okay, they will pay dividends. Most of them will definitely pay dividends. If you find a growth stock that pays zero dividends, 0%, completely no dividends in the context of Bursa Malaysia, I won't invest in that lah. I do not know lah. I haven't found any good ones that pay zero, but I would say in general, most of them pay dividends. It's just a matter of more or less. Okay. So therefore, how do we measure this? We can actually measure this based on dividend payout ratio. So we have a scale from 0% to 100%. 100% means 100% in dividend payout ratio means whatever they earn, they pay dividends. They make 100 million, they pay 100 million in dividends. That's dividend payout ratio, 100%. Okay. So most of the stocks, their dividend payout ratio will be between 20 to 80%. If it's a REIT, okay, a real estate investment trust, it has to be 90 and above. Okay, so REIT will be under this category. But if it's for stocks, typically they will fall somewhere in between here. All right. So if it's 20%, it means to say they make 100 million, they pay out 20 million to shareholders in the form of dividends, they keep 80 million for growth. If it's 80% here, it means to say 100 million they generate cash, 80 million they pay cash to dividends and pay dividends to shareholders, 20 million they keep it, they simpan it for future growth. Okay. So if you're not too sure, is it dividends or growth, you can actually do right in the middle. 50-50 also can, no problem. Some stocks, they memang like that. They collect 100 million, 50 goes into growth, 50 they pay out in the form of dividends. Also can, all right? Just focus on the similarities, which is you have to find companies that are profitable, cash flow generating, where their balance sheet is very strong. That's it. Okay, and make sure you buy them when they are undervalued. So here's a simple checklist, all right, that you can actually do. If you guys know how to read annual reports, if you do not know, never mind, just take down this simple checklist. And all you need to do is just find this kind of information. So in the annual report, there are 3 key statements that I look at. They are income statement, cash flow statement, and balance sheet. So all I need to do is to compile the 10-year sales figures, profit figures, and earnings per share. This is for income statement. And then I'll move on to cash flow statement, where I'll look at operating cash flow, the CapEx figures, and the dividend payments figure, and as well as DPS. This is for cash flow. Final one, balance sheet, is just for stability sake, is to see whether the company is financially resilient. So here I'll be looking at current asset, current liability, just to measure the current ratio. And then I'll look at non-current liabilities and shareholders' equity, just to see their debt levels. Okay. Best to do this, I do this manually without apps, software, or database memberships. I just compile. All I need is 30 stocks, and then 30 good stocks that actually have consistent growth in sales, profits, operating cash flow with good balance sheet. Then you are ready to build a portfolio. All right. So with that, thank you so much for listening to this sharing session, and I'll pass back control to Shane, where we can do some Q&As, where we'll answer some questions of yours lah. Thank you so much.
Thank you so much, Ian, for doing this segment for us. So if you have any question to ask our speaker today, please write them at the Q&A box. Okay, don't write them at the chat box.
Oh, there's a lot in the chat box.
Yep, I think I saw that, the first question on my screen is, which sector did you invest when you grow your portfolio? So this
Which
question is
sector?
by Maslan.
Okay, so I started off in REITs, and of course now I mean to say over time lah. It's not that I'm very industry or sector specific lah, but I do have banks and REITs lah, for the time being lah. Most of them lah.
Okay.
Yeah.
The next question by Theo is that is it necessary for us to do 10-year comparison when it comes to doing the checklist?
If you're new and you're beginning, best to do that lah. Why 10 years? Simply because over a horizon of 10 years, many things happen. Okay? Many things happen. We have trade wars. We have physical wars as we speak right now. Conflicts, tensions, political changes. I'm not referring to our country alone, but the whole world. Even this year, half of the world is going into election. All right. Interest rate hikes, interest rate falls, crude palm oil goes up, crude palm oil comes down, oil goes up, oil comes down, gold goes up, gold comes down. So many things are happening in the world today. We can't control them. There's no way to predict them. Of course, some will claim that they can predict them, but I'm not the one who can predict all these things. I only can say that uncertainties are here to stay. There's no time of certainty. The green lights are everywhere before you invest. All right. It's just uncertain. So 10-year, in this 10-year period, if a stock can deliver consistent growth in sales, profits, operating cash flow while maintaining a strong balance sheet, it is a gem already. Which also means you are also eliminating or avoiding stocks that cannot do so, which will eliminate a lot of risks, a lot of investment risks already. Put it this way lah, investing is a bit like becoming a banker lah. All right, let's say you're working for a public bank as a credit officer. So many people walk into your bank branch, right? So how do you know which loan, which borrower you should be approving? Is it the one which has very strong finances, or is it the one which have weaker finances, where the CTOS score is actually quite poor? So of course you will be more inclined to approve the ones that have a strong CTOS score. Credit cards the repayment behaviors are very good, all right? Has strong savings, has a good job with good pay and all this kind of stuff. Okay. So this kind of borrowers you will likely to approve lah. And then the ones that have a weaker performance in terms of CTOS, in terms of their debt repayment, in terms of their job, not so stable, their job, then maybe you reject their loan application altogether lah. So it's actually the same theory lor.
All right,
All
thank you
right.
so much, Ian. The
Mhm.
next question by Suntaralingam is what about factors like PE ratio, earnings per share, or price to earnings growth ratio? Can you share with us more about these ratios?
Okay, so there are two parts to it. The first one is actually the fundamentals. So I start off with the fundamentals first. Okay. So first and foremost, we are all about accumulating good businesses that actually generate profits, cash flow, and all this kind of stuff. All right. So this will be the priority. With this priority, we can then value the share. That's where you get all your PE ratio, your earnings per share, or PEG ratio, if you like to calculate them. So first priority is the business side, the financial side. The second priority would be the valuation side. Of course, if you find a stock that has no earnings, let's say they incur losses, then there's no PE ratio for you to calculate anyway. So you can just simply avoid investing in this kind of stock lah. Because if a company is making losses, there's no earnings per share, there's no PE ratio. And if the company is making a loss and not really cash flow generative, then how does it pay dividends? Maybe you borrow money from the bank to pay dividends, that is not very healthy lah. Then you may want to avoid this kind of stocks altogether.
All right, thanks so much, Ian, for addressing the question. So the next
Mhm.
question is, under what market condition does dividend investing typically outperform growth investing, and vice versa?
Oh, sorry. Can you repeat the question again?
Under what kind of market condition does dividend investing strategies typically
Hmm.
outperform growth investing strategy?
Oh, I didn't actually study too much about that. So which means to say I didn't really did any studies on that. Maybe because I just keep on just accumulating lah, just accumulating shares. Be it their dividend payout ratio is high or low lah. Just while if the business is good, I just grab lah. So maybe because my focus is on that, I didn't actually like switch. I didn't actually switch dividend investing. Oh, right now is a good time to do dividend investing. Or right now, I think growth investing strategy is more suitable than dividend. So I switched strategy. So I didn't really switch lah. Maybe I just stick to my own game plan from day one until now lah. So I didn't really have any sort of timing. When is the best time to do anything lah? I just like I'm a bit mechanical in that sense lah. If you have a game plan, doesn't matter about the timing, just stick to it and go all the way as long as it is working. So if you happen to have a style that is already working for you, then you can also just follow along, follow ahead lah.
All right, I see. Thanks, Ian.
Mhm.
The next question by Bala is that would you encourage reinvestment of dividend to buy back the shares, or just enjoy the rewards that dividend brings to you?
That depends on your active income lah. So let's say you have a job or you have a business running and you're receiving income and you kind of like receive, hey, you got dividend income coming in from your stocks. So if you have the flexibility to choose, typically what I would do is that I will just reinvest the dividends to actually build a bigger portfolio because that is also capital mah. So you can actually reinvest your dividends back into buying more dividend stocks, and therefore you compound your dividends over the long term. So that is actually a very good thing, and that is actually the best case lah. And but of course, occasionally, let's say it depends also lah. Let's say you have a hobby, you want to travel, and you happen to have dividend income coming in. Okay lah, just take that money and you can spend it on a good holiday. I don't mind that lah. So I mean to say, sometimes life is more than just investing, right? You may also want to you invest, okay, and then the rewards of it you can actually enjoy lah. No problem with that lah. But if you're not traveling anywhere, you got no other reason on where to spend your money, then why not? Why not just reinvest it to compound your dividends?
Thanks, Ian.
Yep.
I think you emphasize the importance of reading annual reports, reading financial statements. So the next question by Afika is that is there any possibility that financial statements are manipulated?
There are cases. I mean to say, I don't dare to say whether there are cases lah, but I would say that there are stocks whereby I read the annual reports, sales is growing, profits are growing, but there's no operating cash flow. Then I'm a bit, huh, okay. Uh, uh, then typically I would just avoid lah, simply because I like it better when stocks that or businesses that actually generate sales growth, earnings growth, operating cash flow must also grow lah. Cannot be operating cash flow negative. Every day also incur cash outflow one lah. If they incur cash outflow all the time, then where does the business actually get the money to sustain the business or sustain its operation? Is it from debt, borrowings from bank, or is it from us investors? So I don't prefer that lah. So that is actually a common way to actually avoid lah. Okay, so this one will take some time to actually practice. But just now, like when I share the checklist like this, okay, I would say that in the context of Bursa Malaysia, you should be doing okay. But at the same time, you might actually, I do not know lah, maybe you hit certain company that memang is a mistake. And because you are new, when you are new, right, here's the thing, you will eventually depending on your journey, doesn't matter where you are, somehow or rather you hit some mistake lah. You you buy into a business believing that it's a good business, but it turns out not to be a good business. It happens. At this stage, how you handle this problem, right, is gonna define you as an investor. Is it number one, if you hit a mistake, and then you say investing doesn't work, you stop there, then no more already lah. But if let's say you hit this bumper, but then somehow you kind of like reflect and then you learn from it, say, oh, yeah, okay, I get it. This is actually where I miss out. And you learn from it, then congratulations. Then you can actually move on and you can actually continue on building your portfolio. So if you follow the checklist, chances are you will do much better than people who don't have a checklist. You will eliminate about, I would say, 70 to 80% of the risk already. But because you're still inexperienced, there's still the 20%, right? So what you can do is that you can split your portfolio. As you build a portfolio, you can split it to a number of stocks, do a little bit of diversification so that in case you really have a mistake, then it doesn't affect your overall net worth that much lah. So that you are still so that you're still sane lah, in order to reflect and learn upon your mistake. Right, Shane?
All right, thanks, Ian. Now, Ian, could you give us some examples of some industries or sectors that are traditionally more conducive for dividend investing and also growth investing? What sectors or industries are more conducive for any of these strategies?
I don't really have a specific strategy. Of course, banks do pay good dividends, okay? So as REITs, but not all banks and all REITs you should buy. You only should buy the top ones, you should only buy the ones that are fundamentally strong, fundamentally sound. You don't want the ones that are fundamentally mediocre. So you only want to buy the cream of the crop in the industry. So banks and REITs are one of them. I would say that of course you can look into FMCG if you want to have something like that. As for the other sectors, I'm not, like I say, I'm not really sector specific lah. Okay. If let's say you're interested to go into tech, by all means you can actually look into tech. If you're looking into plantation, there's not much of a I do not know whether there's a lot of growth element, because there are two types of plantation companies. The first one is that I only have this amount of estate. 10 years later, the size of my estate is still more or less the same. That means to say, whatever they harvest, they pay out to you as a shareholder in the form of dividends. That's one type of plantation company. This one, dividend stock. But another plantation company, they keep on buying other people's estate. They keep on expanding the estate. So 10 years ago, they have this amount of estate. 10 years later, they have this amount of estate. Then suddenly this becomes a growth stock already. All right. So it really depends on what you're looking at lah. Every single sector, right, there is a chance for you to actually buy dividend stocks. There's a chance for you to buy growth stock. So what I'm saying is that it's not so industry specific lah. What's important is the company and where is it going in the future lah. What the CEO is going to do with that amount of cash, where it's going to allocate his capital, that one is more important than what sector lah.
All right, thanks, Ian. So, Zachariah Thomas would like to ask this question: how important it is to put sell stop limit for every dividend stock to protect the capital invested?
I didn't put any stop limit lah, because I'm not trading. So the thing is that I mean to say there are stocks where I just want to accumulate, and I know that I'm accumulating at a very low price. All right, which means to say that the valuation is already attractive. If it drops, it's even more attractive, right? So it's like, for example, let's say a stock pays out 1 ringgit in dividends per share. And let's say I find that the stock is priced at 25. So 1 divided by 25, I'm getting about 4% dividend yield. And let's say I'm happy with it. Then the stock drops from 25 to 20. So 1 divided by 20 will give me 5% in dividend yield. So since 5 is better than 4, I'll grab also at 20. So so if I put a stop loss, I will have sold off the stock. But since, like I said, my intention is to accumulate, not to trade anyway. So if I believe in the business, I find that the business is good, fundamentally sound, it hit all my checklists, and the valuation makes sense, I'll just keep on accumulating, because there's no what you call objective of selling. If I sell, it means that I make a mistake. Or if I sell, it means that personally, I need the money. So that's why I sell. Like, for example, let's say you're getting married, then you need a wedding fund to host your guests, and you need the money. Okay, then you sell. But that one, it doesn't mean that there's anything wrong with the business. It's just that you need the money. That's why you sell. So it's just that reason lah. But the primary objective of owning the shares is not to trade, it's to sell. So if you have a trading mindset, you will definitely put in a stop loss. But since I'm an investor, I just want to accumulate as many shares as possible, so I don't put stop loss.
All right, thanks for sharing with us your strategy. Just
Mhm.
now you mentioned about, value investing is you buy when the stocks are undervalued. So Min would like to ask this question. Would you mind share with us how do we calculate or how do we know if the stocks are undervalued? Which indicator should we look at from the annual reports?
Okay, good question, Limin. So the thing is that I use a few key valuation metrics. The first one would be PE ratio. The second one will be dividend yield. For Bursa Malaysia, these two will be enough. Now, in the annual report, sometimes it will give this kind of, sometimes it will help you to calculate. Let me say the PE ratio and the dividend yield they will actually give you a calculation already. But sometimes you have to do it yourself. Okay, so what happened is that what I will do to determine if a stock is undervalued is this. Step number one, I will calculate its current PE ratio and current dividend yield based on today's price. So let's say today is the 24th of April, 2024. Then I will just calculate the PE ratio and dividend yield for today for a specific stock. Then I take this current ratio, and what I'll do is that I'll take the stock's past 10 years earnings per share and dividends per share. And also I will compile the stock's past 10 years stock price. I'll calculate the PE ratio and dividend yield for every single one in order to create a pattern. Then, so these are all past, right? So from that 10 data, from the 10 PE ratios calculated, I'll calculate the average. So let's say, for example, a stock has an average PE ratio of 20. And right now, the current PE ratio is about 17, for example. Since 17 is below the long-term average of 20, therefore I will deem it as undervalued. So that's how I determine. But so in simple terms, that is actually my method of valuing a stock. But of course, this one takes some practice and there's a fine art to it, and there's case by case So it's actually handled case by case, but most of the stocks in general, I'll use that formula.
All right, thanks, Ian.
Mhm.
So when you talk about PE ratio, right? Chua has this question that do you use the PE ratio that take from the analyst report, or every time you calculate the PE ratio yourself?
I count myself.
You do yourself, huh? Now, just
I
now
do
you
it myself.
mentioned about traps in value investing. So can you share with us at least one or two value traps that we need to be aware of?
All right, good question. Usually, in order to avoid value traps, right, it's very simple. If your business fundamentals is strong, very unlikely that's a value trap. So there are a few forms of value trap, depending on the degree of how you kena the trap lah. Okay, the simple format is the most basic trap lah that people shouldn't be getting into is, let's say for example, just now people talk about the glove because they do not know how to calculate the PE ratio. So what happened is that the first sign they see, oh, the stock price actually come down. Let's say from $8 to $4. Then they say, oi, already dropped by 50%. I think it's a discount. Let's go in. Trap number one, lor. Okay, that's the most basic form of trap. Trap number two is like back to the glove story. All right. When we value a stock, when we value a business, we want to value the business based on its actual ability to generate income, not a one-time off like glove companies suddenly, wow, last time they used to make this much. Now because of the pandemic, it make this much, it's like 4 or 5 times more than what they used to make. So if you calculate PE ratio based on this figure, which is like the abnormal, the very fortunate case lah, okay, the very fortunate year, your PE ratio is going to be very low, and then you buy into that. So that is actually value trap number two. Why I don't use this is simply because, let's say a certain glove company makes about 400 million per annum. Now it makes 2 billion. All right. The question is, can this stock continue to make 2 billion every single year for the long term? So my idea at that time is cannot lah. So what I'll do is that I'll just continue to value the stock based on its actual ability, which is 400 million. Okay. So because I realized this, people who actually value the stock based on 2 billion will be trapped lah. Why is it a trap? Because they think that the PE ratio is very low, single digit. So they buy low because they think that the PE ratio is low, but that's also another trap. The third trap is the business fundamentals is not there, but yet it pays out 8%, 9% in dividend yields. Then you buy into that because you are lured into high dividend yields, but you don't care about the business fundamentals lah. So if you buy into that, thinking that you're going to get every year 8 or 9%, you might get punished lah because you ignore the business fundamentals, which is the source of your dividend income. So these are the few examples of value traps lah that you will learn along the way if you are building your portfolio, if you are moving or progressing towards your $100,000 mark.
Thanks, Ian. Now, when we consider both strategies, dividend and also growth investing, is it important for us to know about technical analysis?
Sorry, technical analysis.
Yep.
Oh, technical analysis.
So when we consider dividend investing and also growth investing, right? Is it also important? Can we incorporate technical analysis into these strategies?
I mean to say, when I was new, I tried lah, but then it's not for me lah. Maybe because of my background as I mean to say I studied accounting lah. So I'll just focus on my core, my strength, which is reading annual reports. So when it comes to charting softwares, technical analysis, like you ask me about volumes, MACDs, stochastics, and all this kind of stuff, I do not know anything lah. So like, do I use this to time the market? I don't do that lah. I don't do that. So it's okay if you do not know lah. But even if you know, I do not know how is it helpful lah. So the answer is I don't think it's that important lah. If it's that important, I will actually know it by now lah. But I don't think I need to know lah at this point in time lah. Simply because I keep all my stocks. I don't sell one. So there's no need to know too much about technical analysis lah. Unless you are not buying a business unless you are just trading. Then different. If you want to trade, then you should follow a trader who trades. The people who buy and sell stocks in the stock market for short-term profits for, let's say, for a very short period of time. Maybe these people, if you're into technical analysis, you should be learning from these people lah. All right. But for me, I know nuts about technical analysis. So, but then my holding period for a certain stock will be very long lah. So it will spend years one lah. So which means to say, if there's a COVID-19, like what happened during COVID-19, oh, my portfolio tank, then I start to find some bargains here and there lor. So which means to say, that's how I prepare for market crisis lah. So it's not by putting a sell limit or whatsoever lor. Actually, if you ask me about stock brokerage accounts, whether or not I know how to use all the functions given by my stockbroker, actually I don't know lah. I only know how to buy. I only know how to buy and sell lah. 90% of the function I do not know one lah. So the answer is no when it comes to technical analysis at this point in time.
Okay, thanks, Ian, for addressing the question. Now, from time to time, we notice that companies will do corporate exercises, in particular private placement. So the question from Sam is that, would you avoid or shun away from company doing private placement because it may dilute the shares?
I mean to say, it depends how often you do it lah. So like just now, okay, now let me share with you this wonderful slide over here. See this, the role of a CEO. 2 jobs, raise capital, capital allocation, right? Now, you're asking a question on raising capital. So I'm looking at the 10-year pattern. So in this 10-year, where does the money come from? I'm looking at, if it's a one-time private placement, I don't mind. If it's two times private placement, I also don't mind. All right. I don't mind if, let's say, most of the money comes from the customer, which is operating cash flow. Okay. So let's say, for example, a company in that 10-year period manages to raise, let's say, 1 billion ringgit in capital. 950 comes from operating cash flow. Maybe 30 comes from that, and 20 comes from private placement. Then I don't mind, because most of the money comes from operating cash flow. So in that case, I don't mind. But if, let's say, the company raised $1 billion, but then the thing is that here it's negative 500 million. Okay, which means outflow 500 million. Here 1 billion, here 500 million. This one this one no more already lah. I will tend to avoid this kind of companies lah, because I do not prefer a company that raises money from banks and investors but keep on flushing out cash from its businesses lah. That is actually not ideal for me as an investor. So I'm looking at so that's why I look at 10 years. I don't look at 1 year. I want to look at a pattern. How does the company raise its capital? That is actually my concern lah.
All right. Thanks so much, Ian, for doing the Q&A session for us. We have run out of time to carry on with this Q&A session, so we will just conclude the session here. So thank you, everybody, for participating in this session. So, ladies and gentlemen, you just heard from the co-founder of Dividend Vault, who is Mr. Ian Tai. Thank you so much, Ian.
Thank you so much, guys. Thank you so much for listening to this sharing session. So appreciative of you here.